seminar, and this is going to be lesson 1 part 2 on the Wilson County Public Libraries, and we're going to proceed with a review of what we covered last week. As you remember, I had done some work publishing, television work, and so on. The same seminar that you're going to take here had been done with the Carnival Cruise Line. We did one from New York all the way down to Los Angeles via the Panama Canal. It was about 2.5-week trip, and the seminar was conducted while we were at sea. So get something to the members to do. It was absolutely free. All you need to do was to pay for your trip. Let me let you know that I'm also collect cars, antique cars and unique cars. This is the Sky, and sometimes we send it into shows on the road. So to show the car, we do this for free. We don't charge anything. We also have the Lions Club when they have a parade or something. We provide the cards in the parade. We covered last week also about reading charts. And we talk about medical chart, like electrocardiograms and all that kind of stuff on it. We're not doctors, so we don't interested much in that, but we're interested in this kind of chart. We want to learn how to read these bars. We want to learn what it means, what it will do with our life, how we can perform. So right here, this is a monthly chart. So every bar represents 1 month. So a different way that you can do it. So here we have 1 month charts, and the whole month went down, and during the month it probably will go up and down, but at the end up. So this is a month from all the way down to here. So this day represent 1 bar. You see, this bar is represented here as a monthly chart. So this is October, July, September, October. So we have some place here in July. That's what we're dealing with. Somewhere with April and May. I don't see that it showed the actual date in here, but this is 1 month bar. You can also do the chart by weekly, a weekly chart. So this bar that we see over here, we're going to name it number 6. What you see on number 6 of 1 month, this is in 1 week, right? So this is a weekly chart, right? And it's going to cover 1, 2, 3, 4, just about 1 weekly bar, right, on a week. But it's the same amount of things, So in the weekly, you open at 317, just like you open in the monthly at 317 over here, and it closes at 364. This is Apple computer at 364. So it's the same, exactly the same thing, The scale is a little bit different because it's measuring by weekly. This is measured by month. And then if we do the June daily chart, then we get 22 bars. So actually it was in June. Yeah, monthly is a month of June. We measure here by weekly. Now we measure by daily. So we're going to have 22 bars on this particular month that it was traded on the exchange, right? But it opened here, it closed here, and as you can see, there were some days during the week, some weeks that there were down weeks. In the weekly, right, we don't see it, but in the daily we see that there were down days here. In the weekly, you don't see no red day because end up going higher in the month. Then you don't see nothing red, not down days, because it's only covering the open at the beginning of the month and the closing on the last day of trade at the end of the month. We can come over here now and take the same chart for June. You're going to cover from June 20, right? 30 days, we're going to have 90 bars at this time. So you're going to cover all this 1 week, second week, third week, fourth week, and few days left before the next month came in July. This is what it ended there. And you can see the whole month was not as pretty, and this stuff here is not as pretty as the weekly. It's not it's not as good as when we see daily, but when we do it by 5 minutes bars, 317, that when it opened, and that's when it closed 30 days later, 364. Same thing. It's exactly the same. It started over here. We're going to measure now every 5 minutes, and you can tell that it was a different stuff. There was time that goes up, down, up, but we end up on the same place. 364, 317, right? 364, 317 for the month on a weekly. 364, 317 doing weekly, daily, and 364, 317 doing it monthly. So it's something for you to, I'm briefing you about this as we go along with the different trades and learning how to read charts. This is a very interesting case. I'm going to talk about how quickly the market reacts when something goes wrong. I think this is, if I can recall right, don't quote me on it, it's irrelevant how it happened, but this is a Southwest airline engine, But the story is this, right? It's not about the engine, but how the market reacted when the news broke out. The plane take off, I think, from Los Angeles. The pilot was a woman with over 10,000 hours experience flying. She was a jet fighter. As a matter of fact, the first woman that was a jet fighter pilot in the Air Force, okay? She got a lot of experience with her. She knows what she's doing and stuff like that. And she landed the plane safely and nobody got injured. But here's the deal. People doesn't know much about plane, but remember I used to be a pilot, okay? Why the engine, this particular plane that has two engines is not an accident, it's by design. They had two engines for the simple reason that the plane can fly for about 6 hours with one engine with no problem. The only problem that I always worried when I was a pilot is about fire. Fire in the cockpit and smoke you cannot see outside, you're going to choke, it's over then, So as long as there's not a fire involved, the plane is safe. But people don't know that, so you get very panicky about it. The plane landed, I think, in Las Vegas or someplace else, and everything was resolved, but this is the result of that. But here what happened. When the news breaks, this is what you're going to see now. This is the stock going very good. This is a 2-minute chart, This is 2 minutes, and we can see that the stock doing very well, okay? The stock moving very good in here. Everything goes very well, but right about 11 o'clock or so, the news breaking news. There's a Mayday call from the Southwest. They are flying from Los Angeles to Fort Worth, Texas. That's irrelevant where the plane was going, but I think that's where the story goes by. And as soon as the news came in, look what happened. Everybody started selling. And so it dropped quickly in a matter of 2 minutes, right? 4 minutes from here to here, and the next minute is way down here. People don't want to know. People behave like cattle. Some of you might don't know about cattle, but if cattle get spooked, they take off. They find out later there's nothing wrong, but they don't take no chances. And we are humans and behave the same way. So as soon as the news broke, people say, hey, I ain't gonna be here. Why is that? The reason that it's like that, because number one, you figure it's gonna be lawsuit, people get killed, or whatever, the plane crash, all kind of legalities involved. Let's get out of here now, and we ask questions later, right? And then the plane landed, right? And by the time it landed, news keep on saying, well, this and that. It goes up a little bit, but it never go back up again, right? And then it start plunging down because, well, maybe they're going to be lawsuits anyway for any injury, or just because it almost ruined my life, or I was late for work, or whether traveling because your engine blew up. So I just want you to know, right, that people react on news very quickly. Okay? Act of God, act of, terrorism, political decision, change the price of the stock market immediately. It don't leave you rest. So you need to be aware of this, This is not what you were planning to see. Probably, I'm going to make money in the stock market. Well, all those things will affect your money. Here is Addison. Here's another experience, This young man used to go by the library, but he never wanted to come into the class. But he goes in there, and he talked about stocks and stuff like that. So I told him, why don't you come to the class? He said, no, it don't waste my time, because it's not worth it for me, because in reality what happened is that you got newbies over there. That's his quote. You got a bunch of newbies over there, so I already know that. I don't need to do that. Well, one day he called me and he said, hey, can you tell me why AutoZone dropped $80 this all of a sudden? So I was not tracking AutoZone. I want to look at it. But as you can see, he was buying option and he was buying a call. As you can see, the stock was going down already. You can tell that. You can see that the indicators right here, you see this is part of learning how to read charts, right? The lines are already going downward. Every signal, the MAC and the SP, RRG are pointing downward, right? So why in the world this guy is buying a call when the trend is downward? This is what happened for the inexperienced guy. What he normally do is this. He see that going down, and then he get flat over here. He say he's going to go back up again. However, he don't know how to read chart. This is what is very important. The chart is telling you nothing like that. It don't say anything like the price going to go up. He acting on emotion. Remember what I mentioned about emotions? That the smart trader live of the naive trader that trade with no education and trade on emotion. This is a guy that traded on emotion. He see it here coming down, and he said, well, it's going to go back up because that's what he saw back here. Well, it was down and going to go back up. However, he didn't know what AutoZone was doing behind the scene. But this tells me, that some people knew and they were selling already. You see, they were selling already because AutoZone make an announcement late in the afternoon the day before that they were selling part and factory business. So AutoZone have two different, just like Home Depot, two different setups. They got your local store that you see bricks and mortar buildings on your neighborhood, and then they got AutoZone with a different name selling parts online. Okay? What really happened is, and they also have a manufacturing company, they manufacture all these parts for them, and they decided that they were going to sell the online business and they were going to sell the manufacturing. But they didn't announce it into here. But I'm very sure that somebody knew, insiders, and they start selling, right? It got flat and they start selling, but he don't educated, he don't know the signal, he don't have to know what happened in the background. What he need to know is this, that he has to follow this line, this chart. He cannot be on emotion. Oh, I think it's going to go back up now, so he jumped in. Well, apparently he invested like a $2,000, okay, on his option, $2,000. And he lost them because that $80 drop, it wiped out his money. So now he's calling me to tell him why it went down. Well, I go and research the news and stuff like that, but he didn't need to call me. If he knew, he had come to the class that my students are naive. I wasted my time with the knowledge I got. Why should I go to your seminar? Even so, it was free, right? But if he know how to read this, he would have never bought a call. He would have bought a put or stay out of it and look something else. The price continued down, not just by $100, but it went from $725 to $600 by the time the game was over, right? It took about 2 months to absorb that loss. Now, here's the other part. It may kind of tend to go back up, right? But it's not over yet, right? There's still bad news coming around and all that stuff on it, and then we get another 100 drop day. So it jump up and then it goes down, and we end up right here down to 600. So the whole thing from almost $800 a share to 600 is almost about $200 drop in a matter of 1, 2, 3, 4, about 4.5 months, $200. Those that hold on to the stock, because it's going to go back up, that eventually it did, right? That's a lot of pain. I don't like pain. So normally we buy and sell, but we insure. There's a way to insure your investment that if something go wrong, the insurance make up the difference of what you lost, okay? This is coming later in the course. But the smart investor just don't buy like that. You can buy insurance to protect your investment. There's no reason for you to lose money unless you're naked. Naked is a term that we use. In other words, you don't have nothing to cover you. You don't have no clothes, you don't have nothing to cover you. If something goes wrong, you're going to lose the money. This is what you're going to learn here. So this is some of the sample of what we're laying ahead for the class. So you'll be prepared to do those things and you won't be losing money. But rest assured, there's insurance to cover the losses. And there are other tricks and strategies that help you protect your investment. So I've been doing this for 48 years, right? I keep on bragging about that, but I had to have some kind of bragging right after been doing it for 48 years, right? After all, that's all I got. I'm 80 years old. Something else. So here is another classic example, right? This is MGM Resort. A lot of people tell me, oh, you always go back up. The brokers tell you, it always go back up. Don't believe that, please. Don't believe it. Okay? Let me tell you why. There's a saying that says that when the tide rise, all ships rise. And when the tide go down, not all the ships rise. They go down, right? Then when the tide go up, all ships rise. Good ship, bad ship. When it go down, not all the ships survive. The weak one, the damaged one, they hit the bottom of the beach or whatever, or the port, and it's over for them. Some of them rise or they're done. Here's a classic example of that saying. In 2008, as we see here, right, MGM was going almost for $100 a share. And this is a weekly chart, but I think it hit 100, okay? So we won't see the 100 in a weekly because a weekly is just whatever it closes at the end of the week. We made a weekly for the simple reason that it's easy to accommodate here and give you a better view of what happened. So you're buying down. A lot of people say, oh, it's cheap, so they start buying because it's going down, right? And it took a year, but by the end of the year, the stock didn't even worth $2. You had lost $98. You lost 98% of your investment. Think about it. If you got like some of my clients that had lost $500,000, that's very painful. Because you might have $5,000 and the other $500,000 is gone. It's very sad. So never believe that the stock gonna go back up just because it went down, and don't buy when it go down. People gonna tell you, yeah, buy because you buy down, so every time you buy down it's cheaper. A lot of people argue with me about that, but you don't know the future. We don't have crystal balls to see is it going to back up. So let's assume that back in 2008, an investor, oh, well, it's down to 80, so he buys some. Here's a gap. Gaps are very important to read, okay? He should have known better. He is an educated trader. You notice that we don't have no indicators in here to tell you, but I'm going to tell you there's a lot to see here without the indicators. There's a gap that goes from 50 to 55, and there's another gap over here too, right? If you get a gap going up, it means that the stock going to go higher, all right? If you get a gap going down, it means the opposite, that it's going to go even lower. So the last thing you want to do when you see this gap, go ahead and buy it because it's cheaper. You don't want to do that. And then sure enough, here we go. And then here go another gap. It's telling you now that $25 is not enough. It's going to be even downward. And it is very downward. Something else that you can read here is the angle of the drop. Notice how it went up. It was going like crazy. It was no end in the stock market. Everything is all gold. Used to be that you buy casinos, you make money because the money is owning a casino, not gambling in a casino. And I tell a lot of people that. You want to make money gambling, don't go to a casino. Buy into the casino, okay? So here what happened. When you see a stiff upside like this, something is on the making. You playing with fire. Well, 2008 comes in, and the casinos already at the beginning of the year, they were already spilling down. Somebody knew that it were bad news. By the time that we get here, you know, on 2000 in November, the market had crashed, everything go down, people investment and retirement account had lost 50%. This is with my friend that I talk about, lost $500,000. He lived with the broker, and don't worry about it, he always go back up. Don't worry about it. Well, by the time he got out, he had lost $500,000. Now, here's my point here, okay? If you have bought this stock 10 years ago, and it's always going to get back up, this is what they say, oh, it's going to go back up, it's going to go back up, yeah, it go back up. And the broker tell you that too. Oh, don't worry about it, market's always back up. Well, I'll tell you what. Here we are on 2021, all right? And this is just before. This is 2020. This is what happened recently when the virus came in March, right? But think about this. In 12 years, the stock only went up to $35. You need another $65 to break even, and it's 12 years later. 12 years later, you're waiting to make up your losses? Dude, if you see this going down, get out of Dodge City. Don't stay there. And those that remained, when they saw that gap, they were not educated enough. And guess what? They went and bought more, and they keep on losing. The more you buy, the more you lose. Don't do silly stuff like that. So this is just an example I want to show you. So even after the pandemic that we're still on it today, you know, when we're recording this, for the 2020 Wilson County Library Seminar, or the 2020 that now is online, it's only about $20 a share. You cannot make no money like this. You got hurt. And I want you to learn from this other people's mistake. No all ever recover from the previous highs. They never do, okay? Remember what I told you before. This is one lesson here that you need to know. I mentioned this before, and I'm going to tell you again. The educated trader get paid from the non-educated, no plan and emotion. And you saw a guy buying options when the indicator going down, he was buying call. He lost his investment playing option, but he called my students newbies. I got plenty of experience. Well, now he's calling me. Why? So I saw the opportunity to advise him of what had happening, but I also caught a picture of that to use it in class to show the students that those things can happen. Let's look at this here now. This is something new, okay? How to make $1 million an hour. I mentioned some of this before. There are people, hedge fund managers, that can make $2.2 million an hour. It's just a disaster. There are people that barely make $5 an hour and are struggling, and there's some guys over there, right, making $1 million an hour. I want you to be aware of this, because this is the guys that you want to follow. You don't want to follow losers, but people do follow losers. Excuse me. I'm getting too emotional about this. When I get involved in this, I'm dedicated. Remember what I say? You have to be passionate about what you do. I am. And you need to be the same way too. So we're going to give credit to this gentleman, Mr. Les Leopold, that provide the information for us on his book. I don't sell in the book. The book, I don't know if it sells or not. I bought the book. I saw very interesting information that I thought I would share, but he needs to get credit for this, okay? So this is what I'm doing that. We're giving credit for the information. So here we go. On his book, he shows how different trades and different professions people get paid by the hour, including Oprah Winfrey that makes $65,000 an hour. I'm not here to cover the books, but I'm going to give the point why I am in this kind of business. So you get CEOs like DirecTV that he gets $15,000 an hour, right here, $15,000 an hour, okay? I don't want to go through all of them because it's a waste of time. We don't need to do that, you know. Here we go for bank and insurance. The guy that runs, let's say, for example, JP Morgan, Mr. Jamon Dimon, he made $9,000 an hour, okay? That's a lot of money. From Wells Fargo, the guy make $8,000 an hour. But then you only get paid 0.25% when you deposit money there, right? Now my money is on Wall Street, where the money is. I don't make it this guy richer. If anybody get rich, it's us, not them. I don't make $9,000 an hour, okay? Highest paid lawyers. The highest paid lawyers, Gerard Horsler, right? $19,000 an hour. Well, anyway, let's get now to the stock market part. Top 10 highest paid hedge fund managers. John Paulson made $2,255,000 an hour. $2,355,000. Ray Dalio. Some of them you see them on TV. You don't believe that these guys are that kind of money. They just look like simple guys. They don't show off their name. Some of them you never heard of them. It's a lesson to this to know. Those that brag about making money is because they don't have any. And those that making it, they don't tell nobody their secret. Okay? So don't buy these courses that, I'm going to show you how to do this, how to show you. I got an agenda. I don't like people that lie to the poor guy and take his money for investing when there's no secret and there's no formula. So I do it for free. In that way, I can tell you how the cow eat the cabbage, because I don't own anything to anybody that I have to paint a pretty picture because he's paying me to do this. I don't get paid. I do it because I want to. There's a guy, George Soros. You know, this guy is the guy that made the Bank of England devalue the money, and he made over $2-3 billion in one day. There's something wrong about this picture when we get like that. But here's an interesting guy, Mr. Paul Tudor John II. He made $211,000 an hour. Oh my God. He's so poor. Look, he can't even compare to the guy that got $2 million an hour. So there's about 15 families that do this in this country. Okay? And I bring it to you for a reason. There's more coming about this and why you have to change your way of thinking and how to do things. This is what happened. This is from the Census. This is from the same guy that produced this, okay, the book. And the top 101%, 15,000 families on the average that make that kind of money, they make about $27 million a year, okay? The top 110%, the top half of 1%, top 1% average about $400,000 a year per group, okay? Top 10%, 75, make about $127,000 a year, all right? I fall in one of these, but I don't fall on this part. Here's the problem. 90% of the working family on this country, 90%, there's a misproportion. You know, it's a big gap in salaries among the workers in the United States. And that is totally wrong. I don't agree with it, and I keep on fighting for, and this is what I'm doing here. 137 million families, 137 million families average $31,000 a year. And I can tell you, it's very sad because there are going to be a lot of people here that get food stamp. There's a lot of people here that get less than that. Some of our servicemen in the military, when I worked with civil engineer at the Air Force, they were guys on food stamp. And they got to risk their life for our country. That's interesting. Well, this guy lived high on the hog at $2 million an hour. It's not right, okay? So this is what I'm going to show you on this class, how to overcome this thing. I want you to move on this side. So whether you fall in, it's up to you. You see it in the video. Think about it. You don't follow the crowd because the crowd is totally wrong. You can tell right here that it's totally wrong. Here is the man that we just talked about it, Paul Tudor John. He's on TV, on CNN, and we're giving credit to CNN, CNBC. On 10/22/2020, hedge fund manager, the guy that make over $250,000 an hour in 2008. This is the copyright material for 2020 TV. It's public information. You can see the video on YouTube, just like you can see the class at the library. But I just want to bring this to a point so you see how simple he look. He don't even have a bodyguard. He just wear a simple shirt with a tie. He don't even wear a suit. But the guy made more than $1 million a day. At $200,000 an hour in 5 hours, he made $2 million a day. I would like to be on his shoes too. You know, I'm happy I make $500 in a day, but this guy made $2 million, so he made me look like throw crumbs at me. Okay, here how the system is so messed up that affects your life, and this has to do with investing. Believe it or not, this has to do with investing. Remember this. During the Carter years, right, the salary, the productivity, and the middle income wages, they were all the same. We're going to see a little bit more about that later. So as the productivity of the country grew, the people participated in the growing of the productivity. And then somehow in 1970, things changed, completely changed. And what happened was that the average guy, the wages, the green line remained flat right here. This is where the 90% come from, right? It remained very flat. The middle class eventually by 2005 making 55,000, you know, and the productivity is keep on going higher, but their salary never keep up with productivity, right? However, think about that. The top 1% income went out of place. When they the top 1% used to make $300,000, now they make $1.3 million. They left all this guy behind. They participated better in the productivity of the country than the rest of them. The rest of us got left behind. This is what you see those 90% making $30,000. Those guys beat us to it. Okay, with that, let's get into more chart reading. We covered some before. You know, this is a candlestick. That's what we're going to use. So we don't want to use the other one, bar charts or line chart. And it's just the regular idea that when the market open and when the market close, and the high of the day and the low of the day. We're reviewing a little bit, but we're going to get more technical on this as we go. A bearish, what they call a bearish candlestick, is one that it can open over here and it closes at the bottom. It was lower, it was higher, but at the end of the day, we end up on this game, lower. Now, here's what I want you to know. Why people follow the crowd when they are 90% run all the time? Why not follow the 10%, the crowd that is successful? Because the smaller the crowd, the more control over the majority. So don't be fooled. You need to join the 10% of the crowd. I'm telling you, and your key is right here with this course. You can make it happen. I started with $500. You can start the same way too. So with that, I'm going to show you what happened to us as a human being. There's a lot of psychology involved in the stock market. This is what I'm showing you this. This is not because I wanted to show it to you. It's because I want you to understand the mechanic, and I need you to change your way of thinking. If you don't change your way of thinking, I'm going to repeat it again, you're not going to make it. So here we go. Okay? We are born into a system, right? That we see our parents do one thing and we continue doing it. Our parents get up in the morning and they go to work. My parents go and buy on credit. My parents all do stuff. He keep up with the Jones. My neighbor bought a car, he could buy one. My parents, the other kids at the school make fun of me because when I get off and they drop me at the school, my parents drive an old car. Well, maybe that's all they can afford. The other guy that get off on a fancy car, maybe they're up to here with bills and they might get repossessed. And believe me, when I used to rent houses and sold property, I have people like that. I finance the house, they go and buy a new car and they don't pay me for the house. They get foreclosed rather than give up the car. They put their family on the street. This is the 90% that cannot get ahead. So the system, you are born into it and you don't question it. You say, oh well, you go and work and pay, work and pay, work and pay, and by the time you're 60 years old or 70 to retire, you don't have a dime in your pocket. You became now dependent from the state to hand you out. And we got lots of them like that. But it's because nobody took the time to teach him, to help him, hey, what you do is wrong, you need to change. It's no different than a guy that become alcoholic. The worst thing you can do is to tell an alcoholic person that he's an alcoholic because he don't see it. No, I'm not alcoholic. I can stop wherever I want to. Well, that's what they say, right? So what you see and follow, we're not questioning. You don't question why the system is like that. You just keep on it because you were born. Think about this. In 1960, Fidel Castro took over Cuba, right? And we talked about that before in the other class, right? About Cuba and all that kind of stuff on it. On some of the videos that I have made, we talk about that. And I say that the company where my dad worked for, they have something to do with helping get in there. But that's another story, okay? Today, those that have born in Cuba all this year, that they never know what the life is like it is in the United States, someplace else, you think they worry about it? No. Their parents became rebel. They migrated to Miami because that's all they know. So when we born into a system, whether it's corrupted or not, You just follow through without realizing it, that you have become a slave of the system. And this is why you have to break out of it. You need to get out of this deal. The world is not like you think. It's not about buying. You're being used. You're being used. But if you don't know it, how can you get ahead? So this is what I'm going to show you here. This is an example. Here's a grasshopper. And the example that I'm going to tell you is that you take a grasshopper, put it in a jar, and there's a guy that tell you, hey, you know, the grasshopper got a lot of protein. If you can raise them, you can sell them. You can sell it to make protein and stuff like that. Oh, really? Okay. So we behave just like the grasshopper. We've been conditioned. And when we don't get out of the glass jar, we're going to be in trouble, okay? You see the world like it's always the same. So you say, hey, I'm going to get me a grasshopper, and I'm going to put him in there and put some little food in here. And next day you come back, you're going to start growing them. But next day when you come in, guess what happened? The grasshopper jumped out of the jar and she's gone. She want to be free. She don't want to be close on that glass jar. You need to do the same, okay? You want to free yourself from the enslavement that we've been subject to all these years, okay? You got to break out of there. So what happened is that next day you say, oh, I'll take care of that. I turn around and put a cover on it, punch a whole bunch of little holes in there. I can drop the food and everything else, and now she can escape. And you're going to get a bunch of big containers, and you're going to grow all this protein to sell. Well, the grasshopper keep on jumping, and guess what happened? It hurts her head until eventually she conformed. And that's what we had done. We conform to the system. So you jump, but now you not jump high enough to free herself. She remained trapped into the system. She been conditioned. We have been conditioned also. Guess what? We've been conditioned, but we don't notice because we say we got freedom. Oh yeah, you got a lot of freedom. Try to get out of the country and see how quick they say, where's your passport? Where is your driver license? He said, well, freed, it should be no problem. Hey, I was born in the United States and coming back in. Show me. You don't have passport? You spend 2 hours at the border or two hours at the airport before you get clear. If you're lucky, you know. I was trapped one time in the Dominican Republic. Spent 2 days over there because they decided that they want to keep what I own. And they say, well, how do we know that you're not trying to get out of the country, right? They just want to keep my luggage, but that's another story. So think about that. Now the grasshopper don't get out. He already, when he jumped, he had known that he's going to bounce the head at the top of the lid. So now he just jump high enough, and you keep on feeding them and growing them, being conditioned. I got a wildcat. I got 2 wildcats. And this is how I domesticated them. I started giving them food, and they came around, and they came around. Before I knew, they get closer and closer to me. I started petting them, and now I got one in here, right on that seat, following me around. She's a wildcat, and she's the Dorset. She got conditioned. Now she depends on me. She lost her freedom. She used to be a hunter. She was a puny little deal, but their parents, they were hunters. They live off the wild. Now she had to depend on me for water, for food. She got a mate. I got one that weighs about 20 pounds too, because they live high on the hog with me. They don't know what is hunting anymore. They got conditioned. It works. We become prisoners of our own destiny. That's what happened. We become prisoners. And we think that we're free, but we're not. So this is one of the things that I want you to show you, right? We've been conditioned and we have to break out of the system. This is part of the class, and you're gonna thank me if you master this, because you're gonna break out of the glass jar. Here what happened. This is in 1950, the productivity, right? The productivity of the country used to go up, and as it went up all the way down to the 70, everybody enjoyed the same quality of life. You got the rich, the middle class, and all of them enjoying the productivity. This is in 1948 to 2011. But in 1970, people got wise, right? And they say, hey, why we should be sharing all this stuff with the common people, the working class, right? And what happened is that all of a sudden, the hourly compensation only had grew up 113% since 1950, but the productivity had gone up 254%. That's what 2010. 2020, 10 years later, this is way up here, and you're still over here struggling. You're still in the 90% going nowhere, you know. And I want you to share this with you to realize why you cannot get ahead. Why you cannot get ahead. Not only you make bad decisions, but at the same time, okay, at the same time, you are being kind of done into this deal and don't realize it. Okay, let's see what we have here. Okay, if you have any question, you remember that you can write to me at Floresville 2018. And now we're gonna go over into some videos for you to see how the market works. We're gonna cover the stock market. On New York Stock Exchange, we're gonna have a little explanation of how the buy and selling take place. Gonna tell you it's not a perfect video for the simple reason that they don't explain in details what's really happening. But I can tell you this, okay? When you buy and sell a stock, the company that you buy is not the one that buying and selling you the stock. They got their money long time ago on the IPO. That's when they introduced the public offering, you know. And price change based on the performance of the corporation. And the buy and selling take place on the secondary market. They don't have nothing to do with you. They can go broke, right? And you just lose your money. They don't have to buy the stock back from you. They're just done, period. So it's a form of borrowing that takes place. Where you borrow money, you have to pay it back, okay? But when a corporation sells stock, it's a form of borrowing money and they don't have to pay it back. Okay, so here we are on the video.
The economy is a lot like the weather. People talk about it all the time. And if you listen carefully, you'll hear adults throw around terms like stocks, bonds, and dividends. To get a better understanding of what all the chatter is about, Nicole went down to the heart of America's financial district.
This is Wall Street, home to the largest money market in the world, the New York Stock Exchange. Behind these flag-draped columns, billions of dollars change hands every working day. It's where fortunes have been made and lost in a seemingly endless cycle. Founded in 1792, the New York Stock Exchange is one of the country's oldest institutions. It's home to over 2,000 companies.
We provide individuals with opportunities to invest in companies and businesses that have great ideas.
Gordon Brown has worked here for more than 40 years. He's even written a book for teens about investing. So, where to?
We're going to go right over here and we're going to start in the main room.
The stock exchange is basically a giant electronic marketplace.
And in a marketplace, you have buying and selling of goods, much like going to a store, buying groceries and other things. Well, that's what happens here. Now, the New York Stock Exchange is the facility where this buying and selling takes place. This is where the investor, the buyer, and the sellers come together.
What they're selling and buying are shares of stock. Stock gives people like you and me an ownership interest in a company. If the company does well, you can make money. If it does badly, you can lose money. So if I wanted to buy shares of a company listed here at the New York Stock Exchange, someone down there has to sell them to me.
If you look directly at the posts, these posts have panels. And under each panel, there is a DMM, a designated market maker. It is his responsibility to trade the stock. There are also individuals who are walking around who are brokers. These individuals receive orders electronically, and then they go out buying and selling for their customers.
So with all that that's going on the floor, all the stocks, all the different companies and firms, is one individual supposed to be responsible for everything and know exactly what's going on anywhere on the floor?
No, what you'll find on the floor of the stock exchange is that the individuals really work as teams.
Gordon explains some of the specialized terms the people here use. For example, the bid is the price someone is willing to pay for a stock. The ask is what someone wants to sell it at, also called the offer.
In this case, right now, IBM has a bid of $126.35, and it's offered at $126.37. So somebody's willing to pay $126.35. Someone is willing to sell it $126.37.
So when the bid was only $126.35 and the offer or the something, the offer was $126.37. That's only a 2-cent difference. Is it really all that significant?
Yes, it is, because sometimes those who are bidding and offering are bidding and offering large amounts of shares. If it's one share I'm buying, oh, it's only 2 cents. But if it's 10, 20, 30,000 shares, then that 2 or 3 cents adds up a lot.
Sometimes to millions of dollars. Here's 2 more definitions. If you believe the market is going up, you're a bull. But if you think the market is going down, you're a bear.
Frank.
Investing in stock gives you the chance to partner with some of the greatest business people in the world.
I don't know Bill Gates. I've never had the pleasure of meeting Warren Buffett. But guess what? Through stock ownership, I can profit and benefit from their ideas.
But investing involves risk. Unlike savings in a bank, with investing, you can lose money. That's why experts recommend that you don't invest all your money at one time. Rather, invest a small amount, but do it on a regular basis, say every month. If history is a guide, over the long haul, you'll come out on top. So instead of a bull, perhaps the statue here should be a turtle. Slow and steady wins the race. For Teen Kids News, I'm Nicole.
We've already learned how to buy and sell money, either with orders or directly on the market. It's simplicity itself with ID System, our trading terminal. Now, there's nothing left to do but to identify the optimum moments to buy or to sell. A mere trifle. This trifle has tantalized traders over the centuries, and a whole science has developed called technical analysis. The Western School of Technical Analysis has its roots in 19th century America. I describe technical analysis as a science. What do I mean by this? Well, one thing I mean is that it's governed by clear and rigid laws. We'll start by learning how to plot price charts using a computer, of course, and then we'll move on to draw other lines. What are they for? Well, these lines help us determine what will happen to price in the future. They also give us an insight into how long price will remain above or below these lines. Today we're going to examine these lines and how to plot them correctly. The simplest price chart is the tick chart. What exactly is a tick chart? Each new change in price is charted by a standard move across the chart. The chart takes no account of time, so the more times that price changes in, say, a minute, the more moves are made across the chart. This means that from 2 to 5 p.m. GMT, when the Frankfurt, London and New York exchanges are all open, there can be up to 10 changes in price in 1 minute.
And late in the evening, at 10 o'clock in New York, when the world's main exchanges are closed, there'll be far fewer price changes. So price is strangely warped and distorted on tick charts.
The tick charts on ID system, as well as those on other trade terminals, do not distort time. Each change in price is charted at the time it takes place. What we have here is a line chart, but one that charts price over a very limited period of time.
What are tick charts for?
Such charts are good reference points and are featured on the trading terminal to instantly inform our traders of any price change on the markets, but they are not used in technical analysis. So what kind of charts are used in technical analysis?
If you look it up in the dictionary, the word bar is a thin piece of metal, and we build our charts with bars. We'll show you how to plot a price chart now.
You already know that Forex is a round-the-clock market, not forgetting the days off. And we've already mentioned that the trading day by international consensus comes to an end at 21:30 GMT. In reality, however, professional traders view the trading session as finishing at 2100. Why's this? Bear with us and you'll see for yourself.
With a bar chart, all the information about exchange price for any one day is shown on a vertical line.
Let's look at the monitor, a heartbeat after the chiming of Big Ben, marking the beginning of the day, and we'll see the first key price that's recorded on our bar. This is the open price, and it's marked as a little nodule on the left of our unformed bar. Punctually, at the end of the day, an instant before the clock strikes, we look at the monitor again, and we see a second currency price. This price is the close price and is marked as a second nodule on the right of the bar. The ceiling that price reached this day is known as the high price and is the third key price. There are no highs without lows, of course, and the price floor or low price on the day is also recorded. We join the high and the low points with a vertical line, and there you have it, the bar. A pretty widespread charting method. The four prices on the bar are referred to as O, C, H and L on the chart.
And day after day, or hour after hour, bar after bar is laid out, marking time with a standard step to the right, creating a reliable price chart. They've been monitoring and studying exchange price behaviour on the Japanese archipelago for centuries.
Rice prices have been recorded since as far back as the Middle Ages. If we want to draw a bar like the Japanese, we make the distance between close and open into a white rectangle, and the high and low prices are joined to it with vertical lines.
This new figure is called the Japanese candlestick, known to some traders as the candle. The rectangle is called the body, and the vertical lines are the shadows.
The candlestick body can change colour. If close is higher than open, as in our case, the body is white and it's rising. If close is lower than open, the candlestick body is black and it's falling.
Many traders find the candlestick more visually appealing and easier to interpret.
Take a look at the candlestick chart. With an uptrend, the chart brightens, and with a downtrend, the chart on the contrary darkens. When price is in a range, it flashes before our very eyes. We'll return to trends later.
History has provided us with a fascinating case study. Two independent groups of traders analysed the same phenomenon over a long period of time. They did not exchange any information, and yet they came to the same conclusions.
In Japan, where the candlestick was invented, a strict isolationist policy was in force until 1862, and this is why Japanese traders could know nothing about the American bar.
Because of these restrictions, and because of geography, candlesticks and bars were created completely independently of each other.
Although they were developed at different ends of the world, both bars and candlesticks use the same four main prices in their construction: open, close, high and low. This supports the thesis that exchange price behaviour is objective in character and submits to rigid laws.
Technical analysis is involved in the study and application of these laws.
The concept of trend is crucial to the technical approach to market analysis. Every tool that the trader uses, whether it's support and resistance levels, chart patterns, moving averages, trend lines, whatever, are applied in order to achieve one super task. The trader, that's you, uses them to identify and monitor a trend to allow them to do further work in its channel.
Let me digress a little here. I said work rather than play. When you play the market, it's very easy to lose money, though it's not impossible to win. But when you're working on the market, the only possibility is to earn money.
You'll often come across advice like never trade against the trend, or the trend is your friend. So we'd better define a trend.
Generally speaking, the trend is the direction the market is moving in, but in my opinion, this definition is an overgeneralization.
In real life, no market moves in a straight line. A market moves in zigzags which resemble waves. Price rises and falls.
It's the directional dynamics of these maximums and minimums which determine trend.
The dynamics of these peaks and troughs, whether they're ascending, descending or horizontal, tells us about the character of the trend. If each subsequent peak and trough is above the previous one, we have ourselves an uptrend. It follows that if each subsequent peak and trough is lower than the preceding one, we've got a downtrend on our hands. If the peaks and troughs are at the same level, this is a range. Always remember that price can move in three directions: up, down and sideways.
Many beginners make the elementary mistake of thinking the market can only move up or down.
And it might surprise them to learn that, even according to the most conservative estimates, for about 1/3 of all trading time, price is neither rising nor falling generally.
This kind of price movement is known as a trading range.
This sideways movement, caused by similar up and down fluctuations, reflects a period when price is in balance, when the parity between supply and demand for a given good is practically constant. Charles Dow, one of the earliest pioneers of technical analysis, called this movement a line. Trading on the exchange is a piece of cake. Any trader has just 3 options: to buy, to take a long position; to sell, to take a short position; or, in general, to do nothing, to wait, to sit on the fence. If the market is trending up, it's time to buy. If it's down, sell. But if the market is flat, the best course usually is to do nothing.
But how can we learn when to do what? The answer's simple. Get into technical analysis. The majority of its laws and findings are the result of the blood, sweat and tears of numerous traders. These lessons were learnt the hard way. And remember, the wise man learns from the mistakes of others. The fool learns from his own, if he learns at all.
And that's straight from the horse's mouth. As well as being able to move in 3 directions, the trend can be one of 3 degrees. These are the primary or major trend, the secondary or intermediate trend, and the minor trend. These terms relate to the temporal nature of the trend and were introduced by Charles Dow. He defined the major trend as existing on the market for more than a year. These long-term price movements are shaped by fundamental factors. Let's take oil as an example. Consumption is growing each year. Reserves are limited. The situation in the Middle East as the main oil supplier continues to grow more unstable, and alternative sources of energy are still inadequately developed. The result of all this is that the price of oil has grown steadily over the last few years, and we can see this on the line chart. Dow defined the intermediate trend as lasting from 3 weeks to 3 months. Minor trends last no more than 2 to 3 weeks at the very most.